The mortgage securitizations, culprit of the global economic crisis. These crises affected so many people. And as we can see in our chart, it's all start with an home purchase. And then along the way, investor far away get some stake in this mess. Where should we start? I think Tom Cruise. We should start by Tom Cruise. Let's watch a little bit.
Show me the money.
Jerry, does that make you feel good just to say that? Say it with me one time, Jerry.
Show you the money.
Oh, no, you can do better than that, Jerry. I want you to say it what you would mean it, brother. Hey, I got Bob Sugar on the other line. I better hear you say it.
No. Show you the money.
Not show you. Show me the money.
Show me the money.
Yeah. Louder.
Show me the money.
I need to feel you, Jerry.
Show me the money.
Jerry, you better yell. Show me the money. Show me the money. Do you love this black man? I love black people. I love black people. What you gonna do, Jerry? Show me the money.
Congratulations, you're still my agent.
Okay, now we are back to the mortgage securitization culprit of the global economic crisis. And what we're gonna do, we're just gonna follow the link, okay, at every step. So we are right now at this step. So that's the borrower. Basically, the borrower want to get this house, okay, and then how to get the money, because that basically sometime might cost like $200,000, 300,000. It's a lot of money. So how are we gonna get this money to buy this house? So the first step, what's gonna be the first step? The first step, here we are in the originator house. The originator house. In the past, originator was like service saving and bank saving and loan bank. Okay, that was a saving and loan bank. But right now they call them broker. Basically, what they do, broker, they are working for a bank. So basically, they got a fee for every customers, every borrower, every transactions. They got a fee, which means they have like an incitations to get the job done in order to get the fee. So basically, that's the borrower. We want the purchase. He's gonna sign the agreement. Okay, since he want to have this fancy house, the agreement gonna say that the borrower gonna pay specific amount of a specific date. But the broker job is to find out if the borrower the creditworthiness of the borrower. So if this person got really enough money to specifically pay, let's say 1,000 or 2,000 every month, that is job to find out that, and to do that employment history stuff like that. But what happens? What happened? So many workers, since they get a fee for all the job, so they just want to get as many as more possible. So they don't care really if you don't have enough credit for that. They just don't care because they are not the one that's gonna give the money. The money come from a bank. So if the thing messed up, they are not affected. They still got their fee. So that's why they just, so let's say they don't, let's mean verify unemployment, you can just put you working somewhere. They're not gonna make a verification to make sure that you're telling the truth. So it start with that. It start with the fact that the broker, they just looking for to get a fee, and then they don't. So the problem is they don't care if you can't really pay. Okay, that's about which means This borrower didn't have enough possibility to afford this house, and the broker didn't care because they got a fee for that. And let's say the government was involved also, because the down payment also, the government, they make the down payment, they implement some law that require little amount of down payment, which facilitate the fact that borrower that couldn't afford with little piece of down payment, they got the house. So it start with that. Okay, no, we remember, we are following the process. So we are here at this step, the borrower, to get this, he decided to sign this loan agreement, and then basically the broker didn't do his job. So how can we explain that pension fund, insurance, someone that is in so far away is affected? How do we explain that? So understand, let's move to the next step. We're gonna move to the step. Okay, let's move to the next step. We're gonna understand. Okay, like I told you, the broker is not the real originator. So it's the bank. Okay. So what's gonna happen is, like, in exchange for cash, okay, this bank gonna gonna sell this mortgage. That means the mortgage to a securitizing firm, okay? Another company, let's say like Merrill Lynch Investment Bank. So this bank gonna just sell in exchange for cash. So this investment bank gonna buy this mortgage from this bank. So we have like a transfer of ownership. Instead of this bank, another big bank like investment bank, they're gonna get buy this mortgage. So those big bank like Merrill Lynch Investment Bank, uh, they're gonna buy a lot of kind of mortgage like that. Say the magic's gonna be there. They are the one that gonna do the magics. They are the one that gonna do the magic. Okay, so they are the one that gonna convert this mortgage into a kind of investment. Okay, let's follow the link to see. So here we see a transfer of ownership, which means if I have to show the borrower, so which means this borrower now is not gonna, his money go directly to this investment bank, since this bank sell to this investment bank, which is, so those banks gonna buy plenty of mortgage like that. That's why they're gonna create, let's see, they're gonna create what we call, there it is. So we're gonna have a pool of mortgage, that the investment bank, they're gonna buy a lot of mortgage, and then they're gonna create a pool. And this pool, we're gonna have like insecure mortgage in the middle and some secure mortgage. As you can see, the expected return, we can see the expected return is, so it's less with the secure mortgage. When we're talking about the secure mortgage, are the mortgage that will show the borrower is stable are gonna have to pay, but we know there are some that are insecure. That's why we got more return on them. So they're gonna create a pool of different mortgage, and what they're gonna call them, they're gonna call them collateralized debt obligation. Okay, collateralized debt obligation. In another term, they're gonna call them CDO. And collateral debt obligation, they're gonna, here come the investor. So they're the one that gonna sell those assets, special asset, they call it the magic asset, because they are able to combine stinky mortgage that not secure at all, and then they will These combination, they just gonna sell them to some different kind of investor like pension fund. So they're gonna sell them like pension fund, insurance company. So understand pension fund got investor. So that's why investor gonna get affected if there is anything happen here. You understand the link? Okay? So investor, so we can have this for the investor, different type of investor, because they are the one that gonna sell those combination of different mortgage to different type of investor. We say a insurance company, a pension fund, hedge fund, stuff like that. So normally, if all goes according to a plan, payment on the mortgage eventually return to the individual who originally provided the cash. That's the point. If all goes pretty good, okay? But in this case, the chain was has broken by way of mortgage default. Here we are. We got some mortgage. Bing. Let's call it red line. Some mortgage start to default. Some mortgage start to default. So which mean which mean those which mean those institutions, they don't got any money. So that's the problem. So since we got mortgage starting to default, they are the one that's supposed to pay, to give a periodic payment to the investment bank. Investment bank don't receive any payment, which means investor don't receive any payment. Here we are in a mess. Okay, so now let's understand some aspect of this mess. Okay, the major problem was the fact that what they call subprime standard. Subprime standard. What it mean? Subprime standard. It means that the system, the way they started, the rule, some people, I'm talking about the borrower, some borrower that they were not able to purchase because there was specific down payment. There was specific down payment. What they do, they lower the bar. They lower the bar. They lower the requirement for down payment. So, which means there are certain people that really couldn't afford the kind of down payment. Now, according to the new rule, we are talking about in the 1980s, 1990s, regulation did not permit. So, but in the mid 90s, a Washington payment related to the South, a Washington politician wanted to extend home ownership to groups that traditionally had difficulty obtaining mortgage. So what they did, a regulation was relaxed so that non-qualifying mortgage could be securitized. That's a problem. So we see a relaxation of regulations where down payment, relaxations of regulations for requirement of down payment. That is at fault too. Sure, we understand the broker. We understand, like we told you, broker didn't evaluate properly, but also the new regulation, make mortgage riskier because they are what we call the category subprime standard. Okay, we have also the fact that with more people, we have the fact also that the low rate mortgage payment. There was also what we call low rate there is a problem of the low rate also. The rate. Remember, uh, remember the Federal Reserve went at an historic interest low rate, really low, near zero, near zero rate. Okay, almost zero, which means this historic low rate, okay, made mortgage payment lower. That's the point. This historic low rate that made mortgage payment lower, which made ownership seem even more affordable again. This is contribute to an increasing demand for housing. So understand this historic low rate that make mortgage payment so affordable in parentheses is because it was the low rate. Because along the way they will not be able, the rate will increase, which means at some point those specific borrowers will not be able to pay. Okay, but understand also, we have to understand that some borrowers were greedy because they want to have the fancy house, even though they know they couldn't afford it, but they just couldn't watch this. And then since they say you can have it, and the fact we have to understand broker also, they started with a little payment monthly, and they told you that will increase. Let's say if they start you if with 840, but along the way you will have like 2,200. How you will you be able to pay it? That's the point. You start me with 840, but if I cannot pay the 2,200, that's a bad deal. Okay, so that's what the point also too. So because what they did what we call an ALM, ALM, initial rate. Okay, ALM, which with the tradition, because we didn't have a fixed rate. Okay, but with ALM we have like we call an increased market interest rate. Okay, so that will cause a trouble for the borrower, because along the way they will not be able to pay. Okay, and then we one more point to signal broker, really they don't care as long as they get the fee. They're not gonna make any control if you have of your credit worthiness, because they are working for a fee. Okay, so that's what the point. uh, if rating agency also were at stake. Rating agency, we were talking about Moody, stuff like that, because they rate mortgage that was with an AA standard. When I mean AA standard, good investment, and then those investments were really, there was a lot of risk in those investment. So these are some actors that were involved in the trouble of the global market crisis. Okay, so rating agency, they were involved. Okay, so that basically an idea to understand, the problem of the global economic crisis. uh, Mainly the mortgage crisis was a key. That was not the only key, by the way, when we're talking about global economic crisis. But everyone agreed that the mortgage securitization was a key point. Like we told, these was a culprit. Okay, mortgage acquisitions, culprit of the global economic crisis. That was not the only thing, but that was effectively the one fundamental element in the global economic crisis. Okay, so subscribe to the channel. We are doing different tutorial on financial on financial management, and we're gonna solve some financial math. So stay tuned and subscribe for more video like that.